WPP and Publicis are, if you like, the flag bearers, some of the early dinosaur stocks that are getting eaten away by the digital age. Now, that's a structural issue. They've tried to capture some of the advertising revenue that the traditional media has lost. They failed, frankly, to be able to do that. And therefore, you have to restructure these businesses down to what are cash generative cores, and they become utility style operations. Now, there's nothing wrong with that. There's plenty of business to be done on that basis. But I think the investors have got to realise that, one, their returns are basically dividends and cash. I mean, they are very cash generative businesses if well run. And secondly, they're much smaller and their growth levels are much lower than they would have traditionally been. Now, having said that, the WPP process of going through restructuring the businesses is entirely sensible. That's a very logical thing. Sorry to contradict you, Jeff, to contradict me, but no, I think you're absolutely right. That actually slimming the businesses down is the right process to go to get to what is a stable, probably slow growing, if growing at all, highly cash generative, highly repetitive series of businesses, which is what the management are trying to do at this moment in time. The question for the market is, having derated, an old economy business with no new economy re-rating, what actually do you end up paying for these multiples? And I wouldn't mind guessing in 10 years' time that they don't exist on the market at all, that they're actually taken over private equity, because they will have high yields.
Wow, that's a strong call, isn't it?
It's a very long-term call.
It's quite in contrast to what you typically see, in the sense that when you have an industry under pressure, often there's more consolidation. You see one company entrench its power to try and minimise costs. But I mean, these were two businesses, or WPP in particular, it was a huge acquirer. So it's sort of the opposite strategy now, where we see the businesses too large to run fast, and what you've got much smaller competitors. Does that strike you as some irony that you're not seeing this huge consolidation?
Well, I mean, I think it's very much a way of saying, look, the business approach of the 90s and the noughties is inappropriate for, the 2020s. That big conglomerate, lots of different affiliate structures which kind of run themselves, and you have, a grand homme, and in both cases, both companies had them, coming in and managing those businesses, acquiring things that look a good idea and letting them run with themselves. It's over, it's finished. We don't run in that particular way. You can't imagine a Facebook or an Uber or any of the large digital businesses that exist today running on that basis. They don't. They have a single metric and a single way forward, and they add other metrics which are absolutely aligned to that. And that's not the way this business has been run.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.